Hey guys, thanks for joining in. So today I want to share with you the importance of saving receipts, right? Saving receipts may seem like a very annoying task that you probably heard from your tax accountant telling you, hey, keep your tax receipt, keep your receipts. You know, it's frustrating, but it is absolutely essential to have receipts when it comes to claiming tax deduction. Because generally speaking, in order to claim any deduction, IRS requires receipts as proof that you actually spend the money, right? Without them, you're not going to get the deduction that you wanted. They're going to disallow it. So, in order to prove this point, I want to share with you a hypothetical situation. And I'll use Section 121, which is the primary residence gain exclusion provision, as an example, because that tax code is crucial tax code that all physicians should know. So let's do a quick review of Section 121, and I'll explain how it applies. So according to IRS tax code, Section 121, up to $500,000 of capital gains when you sell your primary residence at a gain may be tax-free as long as you and your spouse lived in the house for the past 2 out of the 5 years before the sale. When it comes to 2 out of the 5 year rule, it doesn't have to be a consecutive 2 years. It could be 6 months here, 6 months there, and 1 year there. As long as you add up all the time that you lived in it, owned it, exceed 2 years out of the last 5 years, you could meet this eligibility. But what people don't realize is, keeping the records of all the money that you spend on home improvements. We do a lot of home improvements as homeowners, right? May be crucial to fully maximizing the Section 121 exclusion, and you can potentially save thousands of dollars in taxes. So I want to go over an example. Right? This is just hypo. So say that there's two doctors, Dr. Katz and Martini. They bought a home in Oakland in 2014. That was the best time to buy, and they before got married. Right? They made significant home improvements over the years. He was, contractor, and sold their home 10 years later in 2014. Right? So let's assume that they bought the house for $1 million, which includes escrow and fees, and they sold it for $2 million. But they spend $500,000 to improve the property. So let's do a capital gains calculation. Here it is. You spend $2 million. You sold it for $2 million, but you bought it for $1 million, and you spend $500,000 to improve the property. So when you do the math, your capital gains should be $500,000. So as long as Dr. Katz and Martini can prove that they spend $500,000 on improvements, they can use a Section 121 exclude the entire $500,000 gain from taxation. But what if they don't have proof? They're too busy. If they don't have the receipts or any other documentation for the improvements, the IRS may treat the improvement cost to be zero, fat zero. So what happens? So if IRS disallows the $500,000 that is spent on home improvement, the capital gains calculation could change significantly. Let's assume that there's no proof of improvements at all. So revised capital gains calculation is as follows. They sold it for 2, bought it for 1, 0 in improvements. That means they would have $1 million in capital gains. So first half $500,000 can be excluded under Section 121, but the other $500,000 would be taxable as long-term capital gains. So what does that mean? For a high-income couple like them, assuming that they make 1.1 million bucks in combined wages, their tax rate on the capital gain could reach 40% plus. And here's a breakdown. So federal long-term capital gains is going to be 20%. California, great state of California, 12.3%. And net investment income tax is going to be 3.8%. So total is going to be more than 40%. Time that on $500,000, they're going to have additional $200,000 plus in taxes. So the key is save your receipts. In order to claim deductions, you got to have receipt to substantiate your expenses, right? So proper documentation or keeping the receipt on the home improvements cost can save you thousands of dollars in taxes. So remember this. Hold on to the records, right? Because they could be worth weight in gold. Hope this was therapeutic. I'll see you guys next time. Goodbye.